Hello friends and welcome to the another lecture on construction economics and finance. So in the lecture series we have seen that how this construction economics, how this construction industry is contributing in the growth of the nation. Right from the beginning we are considering this, we are learning this, and also we have studied the various aspects of finance and economics which is applicable in the construction industry. So moving further, today we will see how this income statement, balance sheet are useful in the construction industry. So our today's topic is the income statement and balance sheet in construction industry. Okay. So before starting actually the lecture, I would like to introduce myself. I am Professor Amey Khedikar, working in the Department of Civil Engineering at Tulsiramji Gaikwad-Patil College of Engineering, Nagpur. Okay. So income statement and balance sheet. Before actually looking towards the application of the income statement, balance sheet in the construction industry, okay, in big industries like Gammon India, big companies like DLF, they are having billing office, finance office, where billing is done. So, what is the importance of income statement and balance sheet that we will see? But before actually studying the application, we must see what is income statement and what is balance statement. So, what is a financial statement? So, financial statement is categorized in three parts: income statement, balance sheet, and cash flow statement. In the income statement, it is again having three types: revenue, expenses, and profit. Rather, having types, it comes under the category of three types: revenue, expenses, and profit. Then balance sheet, assets, liabilities, and equity. In assets, current and non-current, liabilities also current and non-current, and equity paid in capital or retained earnings. And cash flow, that is operation, investment, and financing. So this is the uh, dividation of the financial statement into the three categories, that is income statement, balance sheet, and cash flow statements. Now, coming to the income statement. Income statement, it presents financial record of a company, its revenue and expenses. So all the things which comes under these companies' revenue, expenses, and profit over a period of time. Let's say an example of for financial year of FY, financial year 2021. So whatever the investment, whatever the revenue, and whatever the expenses done, so entire database should comes in the income statement. It also gives firm financial performance in terms of revenue, expenses, and profits over a given time period. It focuses on revenues and costs associated with the revenue. That is the income statement. The operating section of an income statement includes revenue and expenses. The non-operating section includes revenues and gains from non-primary businesses, activities, also expenses that are either unusual or infrequent. Finances cost like interest expenses and income tax expenses. Basically, reading on income tax, this is just sample example of the statement where sales is should be like this and gross profit, then operating expenses, general administrative expenses, selling marketing expenses, research development expenses, then operating income, interest expenses. So this the statement is generated like this in the format that may vary as per the company and as per the demand. Okay. Now, why income statement? Okay, the income statement is one of the major financial statement used by accountants and business owners. See, in the construction industry, I have told in the beginning. Let's say an example of Gammon India, DLF. These are the multinational companies. So they are having their own house offices. In that office, there is a billing section, estimating section, execution section, design section. So billing is also very important where all the documentation is done. Okay, it shows the profitability of a company during the time interval specified in its heading. It helps in identifying risk and opportunities and forecast future performances for owners, investors, creditors, and competitors. That's why the income statement is important. Usefulness. Evaluate past performance. We can learn from the past and cannot repeat the mistake in the future. Predicting future performances. Help assess the risk of uncertainty of achieving future cash flows, company and limitations. Companies omit items that cannot be measured reliably. Income is affected by accounting methods employed. Income measurement involves judgment. Okay. A financial statement that summarize a company's assets, liabilities, and shareholders' equity at a specific point of time. The accounting balance sheet is one of the major financial statements used by accountant and business owners. It is also referred to as statement of financial position. Okay. So as far as balance sheet is concerned, that is a very important and very good aspect of this businesses construction or any kind of. So it is basically a financial statement. What is balance sheet? Is basically a financial statement that summarize, okay, all the assets of the company, shareholders and equity, especially at specific point of time. Then the accounting balance sheet is one of the major financial statement used by accountant and business owners. It is also referred to as a statement of financial positions. Component of balance sheets, assets, liability, owner's equity, and basic accounting equation. Okay. So even you can see the assets equal to liabilities plus owner's equity. That basic equation. Okay, you can simply calculate the assets. So what is assets? It's anything tangential or intangible. It's basically anything that is tangible or intangible which is owned by, leased by a business, which is owned or leased by a business. Okay. What is liability? It's an obligation which a company owns to another business entity. Owner's equity, all claims of the property or partner or stakeholder against the asset of a firm equals to the excess of assets over liabilities. Basic accounting equation, relationship that states that assets equal liabilities plus owner's equity. So the basic accounting equation is that it is, you can see the relationship states that the asset which is equal to the liabilities plus the owner's equity. Now reading balance sheet. So basically assets and liabilities were current assets just like cash, accounting receivable, inventories, prepaid expenses, and a fixed like land, building, equipments, investment, goodwills. And liabilities, current liabilities, non-current liabilities. In current liabilities, accountant payable, accrued expenses, IT payable, short-term debit, bonds payable, long-term borrowing, owner's equity, common stock, retained earnings. And this is the reading of balance sheet. Now, why balance sheet? Why it is required? Why it is useful? A balance sheet offers a way to look inside your business and outline what it is really worth. A balance sheet is different from measure of profit and loss. It is not directly associated with which is profit and loss. That is different statement. But balance sheet is not that which is showing profit and loss. It's a list of assets and liabilities, basically. Any good balance sheet includes some basic, just like what are the business owners, real estate, vehicle, office equipment, etc. Revenue you expect and take in accounts receivable, and expenses you expect to pay out. Okay, what are the current liabilities? What is the revenue expected and what is the expected payout? That is the balance sheet contains. The balance sheet is usually used to assess the value of our businesses at any given point. It helps to keep track finances. It helps for showing it to investors and bank managers. Also, it is useful for annual accounts, for financial audits, especially. So here are some formulas we should know as far as the examination is concerned, and in the MCQ format, these questions may arise. Okay. So gross margin is equals to gross profit divided by sale into 100. Why into 100? We always want such kind of things in percentage. Net profit margin equals to net profit before tax upon sales into 100. Return on net asset, net profit before tax upon assets minus current liabilities into 100. Net asset turnover, sales by net assets. Stock turnover, sales by stock or stock into 365 divided by sales for annual turnover. Current ratio, that is the current asset divided by current liabilities. Net worth, total assets minus liability to outsiders. This formula you must keep in mind. Moving to the next part of the lecture, that is the reading and understanding basic financial statements. Okay, now we have seen what is balance sheet, what is okay basic things, why it is important, which are the formula. Now going to the next part of the lecture, that is the reading and understanding basic financial statements. Okay, make better use of information and in financial statements. So primary financial statements, such as, though we have seen few terms, but we will revise and we will again go into the broader way now and try to understand each and everything. So basic financial statements are balance sheet, income statement, statement of retained earnings, and statement of cash flows. Okay. Now primary financial statement in that continuation. Primary financial statement answers basic questions including what is the in the basically primary financial statement, these things are covered just like what is company's current financial status, how much invested, how much borrowed, loan, etc., liabilities, all the things, salary expenses and all. What are the company's operating results for a period, and how did the company obtain and use the cash during the period. Okay. In balance sheet, summary of the financial position of a company at a particular date, like assets, I have already told you, cash, accounts, receivable, inventory, lands, building, or any kind of other infrastructure, equipment, and tangible items, intangible items. Liabilities, accounts payable, notes payable, and mortgages payable. Okay, and owner's equity, net assets after all obligation have been satisfied. And following things covered in the balance sheet, like what are the resources of the company, where the financing we have got, what is the source of finance resources, what are the company's existing obligations that cover in the balance sheet, and what is the company's net assets. Okay. So accounting equation, as we have seen earlier, assets is equals to liabilities plus owner's equity. So what are assets? Like resources used to generate the revenues, like creditors claim against resources plus owners claim against resources. Okay. Assets, and this is just basically an example, and I am putting here some figures and simple example to understand the simple and structure of the balance sheet. Cash, then accounts, receivable, land, total assets around 340 rupees. Sorry, dollars, US dollars. Then accounting, then the accounting payable, not payable, owner's equity. This is the structure or the sample of balance sheet. Now, classified and comparative balance sheets. They distinguish between current and long-term assets, current and long-term liabilities listed in decreasing order of equity, comparative. So, financial statement users can identify significant changes over time. They have more than 1 year of the balance sheet. Okay, so comparative is the financial statement users can identify significant changes over time and they have more than 1 year of the balance sheet. Basically, current and long-term asset along with the current and long-term liabilities, these are the two distinguished things. So balance sheet limitations. Assets are recorded at historical value. Only recognized assets that can be accessed in monetary terms. Owner's equity is usually less than the company's market value. Okay. Basically, the income statement shows the result of company's operation over a period of time. Okay, what goods were sold or services performed at a provided revenue for the company. For example, I am having a Zindal steel company. I am supplier of the steel or I am a supplier of paint. So how much goods sold and services provided, okay, that and how much revenue has been generated to the company. Okay, along with that, what costs were incurred in normal operations to generate these revenues. So all this point, earning and profit to the company, all this comes under the income statement. Okay, revenues, assets, cash. Okay, expenses, assets, okay, annual things, revenue, and net income will be revenue minus the expenses. Whatever the revenue we have generated for a financial year minus the investment or expenses we have done. For example, company income statement for the year ended December 31. Okay, this is example. I have shared with you. So basically statement of retained earning. So beginning retained earning plus net income minus dividend paid equals to ending retained earning. So what is net income? Net income results in increase in net assets, increase in retained earnings, and increase in owner's equity. What is dividend? Decrease in net assets, decrease in retained earnings, and decrease in owner's equity. And finally, basically an additional financial statement that identifies changes in retained earnings from one accounting period to the next. Basically, okay. See, all these slides whichever I have made, all are self-explanatory, and the things formulas I am putting just I am reading sometimes, but it is basically to understand and relate all the things with any example. Just like in the last slide, I have given the example of, see, I am the supplier of Zindal Steel, I am the supplier of Ambuja Birla Paint. So how much profit, how much investment, what kind of things are required. So it should be kept in the formats, and this format we are studying balance sheet, income statement, all things. It's very simple. Statement of cash flow. Okay, it reports the amount of cash collected and paid out by a company in operating, investing, and financing activities for a period of time. So, how did the company receive cash? How did the company uses its cash? Also, complementary to the income statement indicates ability of a company to generate income for the future. So, these are the statements comes under the statement of the cash. Statement of cash flow. Sell goods or services, sell other assets or by borrowing, receive cash from investment by owners, cash outflows. Okay, we are again differentiating the cash flows in the inflow and outflow. In inflow, goods, services, other assets, receiving cash from investor. We are receiving cash from the investor, source of finance. Okay, and outflows, operating expenses we have to pay. Operating expenses we have to pay. Again, the rupee loans and pay owners for the as a return or investment. Okay. So again, the match classifications, operating activities, transaction, and events that enters into the determination of net income. Now, investing activities, transaction, and event that involves the purchase and sale of securities, property, plant, equipment, and other assets not generally held for resale, and the making and collection of loans. Financial activities, transaction, and events where the resources are obtained from and repaid to owners and creditors. So the operating activities, investing activities, and finally the financial activities. Okay. In operating activities, again, cash inflow and outflow, if we can see the sales, already we have seen, but still we'll again see the sale of goods, sale of good or services, sale of investment in trading securities, dividend, interest. In cash outflow, inventory payments, interest payment, wages, utilities, rent, and taxes. Cash inflows and outflows in terms of now investing activities, sales of planned assets, sale of securities other than trading securities, collection of principal or loan, and in outflow, purchase of planned assets, purchase of securities. See, basically, it is all about sales and investing and selling, investing and selling. So this is the difference. Okay, making loans for other entities, financing activities, cash inflows, insurance of own stock borrowing, cash outflows, dividend payments, repaying principal on borrowing, treasury stock purchase. So the slide showing is basically the segments which covers in the statement of cash flow. Like you can see, the arrow signifies the operating, investing, financing. Okay, which comes in a jar that shows the cash inflows. Okay, operating activities. Jar is a company. What is jar? It's a company. Okay, in the company, any construction company, real estate company, Building material supply company. What is that jar? It's a company. Operating activities, investing activities, and financing activities are the cash inflows. And what is the outflows? Same. Okay. Once you have invested, you will again purchase something, again invest. Once you get investment, again you will purchase something, investing. You get some activities, inputs, again you provide some outputs. That's the basic principle. Okay, so basically these are the some statement of cash inflows where operating plus investing plus financing. Okay, where buildings a pile of a cash, possibly looking for acquisition. Where only operation, there is no investment and financing. So operation cash flow being used by a fixed asset and pay down the debit. When you have operation and investing cost, no financing. In that case, operation cash flow and sales fixed assets being used to pay down debit. Okay. When you have operation and financing but no investment, then operating cash flow and borrowed money being used to expand. In another cases, when you only have investment and finance, then you can operate cash flow problems covered by sales of fixed assets, borrowing the owners and contributions. And when you only have financing, then rapid growth, shortfalls in operating cash flow, purchase of fixed asset can be done. When you don't have operating cost financing and only investing, then sales of fixed asset in financial operation cash flow shortages. Okay, it may short. And when you don't have anything, neither operation, investing, and financing, the company is using reserve to finance cash flow and shortfalls. Okay. And notes to the financial statement, that four general type of note, that summary of the significant accounting policies, that assumptions and estimates, additional information about the summary totals, then disclosure of important information that is not recognized in the financial statements, supplementary information required by the FASB or the section SEC. Okay, in the cash basic accounting, revenues and expenses are recognized only when the cash is received or payments are made. Okay, it is mainly used by the small businesses, not an accurate picture of the true profitability in the cash basis accounting. Okay, and finally, in the concluding part, what is the purpose of this analysis? Basically, the internal users and external users. So, financial statement analysis helps users make better decisions. And managers, officers, internal auditors, external users, shareholders, lenders, consumers, intra-company, competitors, industry, and guidance. Okay, that is the standards for comparison. Intra-company, that is the intercompany comparison. Then competitors, how much they are investing, how much we are investing, how much profit they are getting, how much we are, what are their expenses compared with the profit, what are our expenses, industries and guidelines. Okay. Debit ratio, basically is total liabilities by total assets. Okay, we will again revise. Then the measures of liquidity, also called working capital ratio. Some successful companies have current ratio less than 1, total current assets, total current liabilities. So it is the total current assets divided by total current liabilities. And the total asset turnover, its purpose, basically the measure of any company, which is measured in the annual turnover. In the financial audit, it comes annual turnover. So it measures the company's efficiency. The higher is the asset turnover ratio, the more efficient the company is being to its assets to generate sales. Sales by total assets. Return on sales and its purpose. So measure of the amount of profit earned per dollar of sales evaluated within the appropriate industry. Net income by sales. Return on equity and its purpose. Overall measure of performance, profit earned per dollar of investment, typically between 15 and 25%. Net income divided by owner's equity. Okay, so dear friends, we have seen the entire things regarding the what is income statement, what is balance sheet, what is cash inflow, terms associated with that already. So basically, in any kind of company, especially in the construction industry, as I said, construction industry, you might be imagining only construction activities, but no, it's not like that. In construction industry, there are various offices, there are various portfolios being assigned to various kind of people. execution engineer, design engineer, some of the documentation work like billing, estimation, all these things. So in the finance department of a big construction company, MNC, these are the main aspect you should know, and you should cover all these things. Okay, what is balance sheet? What is the income statement? How it is been done? How this structure of balance sheet? What is income statement? So all these things we have seen. Okay, so I hope students you understand this, and thank you very much for patient listening and watching the lecture till the end. And we will meet very soon in the in the next lecture. Previously, also we have seen the various kind of things associated in the construction industry, and we will meet very soon in the next video with some another new topic. So thank you very much.